Here's something that might shock you. The world's most powerful currency is essentially holding its breath, waiting for a single piece of economic data that could reshape global financial markets overnight. The US dollar maintained modest upward momentum this Thursday as financial markets entered a state of anticipatory tension ahead of crucial American consumer price statistics. These numbers won't just be another economic report. They're potentially the key that unlocks the Federal Reserve's next major policy decision. Meanwhile, across the Atlantic, the European Central Bank prepared for its own high-stakes meeting, leaving the euro remarkably stable at current levels. But here's where it gets controversial. Some analysts believe the market has already made up its mind about what the Fed will do, regardless of what the inflation data actually shows. The primary focus remains squarely on U.S. consumer price information. Financial markets are actively seeking justification to adjust Federal Reserve expectations downward and apply downward pressure on the USD, explained Michalis Rousakis, who serves as a G10 foreign exchange strategist at Bank of America. This statement reveals something fascinating about market psychology. Traders aren't just waiting for data. They're hoping for specific data that confirms their existing bets. Rousakis raised a thought-provoking question that cuts to the heart of current market dynamics. The critical consideration is whether Federal Reserve expectations can be adjusted further downward, considering that approximately one rate reduction plus additional easing measures are already anticipated for September, with nearly 3 full cuts being priced in by year's conclusion. For context, Bank of America's internal forecast calls for exactly 2 additional Fed rate reductions before 2025 ends. The dollar index climbed a modest 0.2% to reach 97.97, demonstrating the greenback's relatively stable performance against other major international currencies. This stability might seem boring on the surface, but it masks intense underlying market tensions. And this is the part most people miss. Recent economic data has been painting a picture that directly contradicts the dollar's current strength. Wednesday brought an unexpected decline in U.S. factory gate pricing, which significantly strengthened market expectations that the Federal Reserve will implement rate cuts during next week's policy meeting. This development didn't occur in isolation. It followed Tuesday's substantial revision to American employment growth statistics, revealing that the United States actually generated 911,000 fewer jobs during the 12-month period ending in March, compared to previous official estimates. These aren't just numbers on a spreadsheet. They represent real economic conditions that could fundamentally alter how central bankers view the health of the American economy. For beginners trying to understand this, when factory prices fall and job creation is lower than expected, it typically signals economic weakness, which often prompts central banks to lower interest rates to stimulate growth. Meanwhile, European financial markets anticipated that the European Central Bank would maintain current interest rate levels during Thursday's scheduled policy meeting. The euro remained essentially unchanged at $1.1686 as investors awaited the rate decision announcement. Market analysts suggested that ECB policymakers might adopt more accommodative language to address challenging trade relationships and political uncertainties throughout the European continent. The shared European currency demonstrated signs of stabilization following 2 consecutive days of decline, even as geopolitical tensions continued escalating along the EU's eastern borders. In an unprecedented development, Poland announced it had successfully intercepted suspected Russian unmanned aircraft within its national airspace on Wednesday, receiving support from NATO ally aircraft. This marked the first confirmed instance of a Western military alliance member engaging in combat actions during Russia's ongoing conflict with Ukraine. Commerzbank analysts offered a sobering assessment in their recent research note, suggesting that expectations for the ECB meeting to serve as a catalyst for significant Euro-USD movement would likely prove disappointing, given the absence of anticipated new policy information. If any potential for market movement exists, it may depend on ECB President Christine Lagarde's communications. Notably, she adopted a surprisingly firm stance during the previous two press conferences, the analysts wrote. However, given that rate reduction expectations aren't anticipated until June of next year, they argued that Lagarde would be unlikely to reveal policy intentions so far in advance. But here's where it gets controversial. Is the market being too aggressive in its Fed rate cut expectations? Market attention remained laser-focused on the Federal Reserve's probable rate reduction timeline. Trading activity currently operates under the assumption that Fed easing represents a virtual certainty, with the only remaining uncertainty being the magnitude of cuts. Current market pricing indicates an 8.9% probability for a substantial 50 basis point rate reduction during the central bank's September 16th to 17th policy meeting. While at least a 25 basis point cut is considered virtually guaranteed, according to the CME Group's FedWatch monitoring tool. Political appointments to the Fed's rate-setting committee remained a significant focus area as President Donald Trump's administration moved Wednesday to challenge a federal judge's decision temporarily preventing Trump from taking the unprecedented action of dismissing Federal Reserve Governor Lisa Cook. The White House seeks her removal prior to next week's Fed meeting, a move that would represent an extraordinary breach of central bank independence traditions. Stephen Miran advanced closer toward Federal Reserve Governor confirmation, furthering Trump's initiative to establish more direct influence over monetary policy decisions. The Senate Banking Committee voted to progress Miran's nomination forward, though participating lawmakers indicated significant uncertainty about whether the confirmation process could be completed in time for his participation in the upcoming policy meeting. Against the Japanese yen, the dollar traded 0.3% higher at 147.96 yen, following data revealing that Japanese wholesale prices increased 2.7% year-over-year through August. This acceleration from the previous month signals persistent inflationary pressures within the world's fourth largest economy, a development that could complicate the Bank of Japan's own policy decisions. The Australian dollar declined 0.1% to $0.6605, retreating after reaching its strongest level since November during Wednesday's trading session. This pullback coincided with commodity markets, including crude oil and gold, surrendering recent gains. For investors, this connection between commodity prices and the Australian dollar illustrates how resource-dependent economies can see their currencies fluctuate based on global demand for raw materials. The offshore Chinese yuan strengthened 0.06%, trading at 7.1232 yuan per dollar. The New Zealand dollar slipped 0.3% to 0.59260. While British sterling declined 0.2% to 1.35105. Now, here's the question that could spark serious debate. Are central banks around the world coordinating their policies more than they're willing to admit publicly? And if markets have already decided what the Fed will do, does the actual economic data even matter anymore? What do you think? Are these currency movements driven by genuine economic fundamentals, or has speculation taken over? Should central bank independence be absolute, or is some political influence actually necessary in democratic societies? The answers to these questions could reshape how we think about monetary policy for years to come.